Hi everyone, welcome back to the USCPA classes for financial accounting and reporting. In this particular video, I'll be giving you the complete overview of current expected credit loss as per accounting standard codification 326 of US GAAP. This is part 1 of ASC 326. We have one more part coming just after this, that is part 2. Please go through both the part to ensure the complete understanding about new accounting standard codification 326 expected credit loss. So let's dive into to understand more in detail.
Hello everyone, welcome to the FAR class. Today we are going to start with ASC 326. So ASC 326 is about current expected credit loss. So this is being like a new accounting standard. Earlier there were multiple accounting standards relating to the expected credit loss. Some one for the receivables, some are for the financial instruments, some are for the investment, but all of them have been clubbed together and new accounting standard codification has been made in 2020, which is being affected to implement for listed company in 2020. Yeah, so for listed company, it has gone effective on 15 December 2019, and for other public company, December 2020, and all other entities other than PBE, it is being effective from 15 December 2021. So now, like examiner have started taking more and more questions from this expected credit loss model, considering this is a new accounting standard codification, and as a CPA we should be aware of all these new changes and new accounting standard codification. So you'll see, like, now probably you may not have too much question in your database or in your question bank to practice, but you have, like, we have um, prepared a sufficient literature for you to equip yourself with the understanding of this new accounting standard codification, so that with your understanding you'll be in a position to crack those questions which may comes in your exam. But parallelly, like, we have few questions in your data, your software. So I request each one of you to practice, and we have also considered certain questions over here as well to help building your understanding around the current expected credit loss method. Right. So jumping into it, like in this expected credit loss standard, so we'll be understanding what all is coming in scope and what all things are not in scope of ASC 326. So for any accounting standard codification to study, first we need to be very much clear what all is in scope and what all is out of scope. Like, most of the time students get confused whether this particular transaction is to be dealt with the respective standard or should not be dealt with. So for that, we should have a clear understanding what is in scope and what is not in scope. Same way how in earlier classes we studied for ASC 606, ASC 842, where we have clearly demarcated what is in scope and what is out of scope. Same way here also we'll be understanding what is not in scope. And then second important thing, parallelly, we'll be covering the objective. When there was so many accounting standards which is covering the same pane, why this new accounting standard has come up? What is the key objective of having this new accounting standard codification 326, right? So we'll be understanding that. In addition to that, within the objective, we'll be understanding the core principles of this new accounting standard codification. So we'll go through all the 4 core principles of the ASC 326. Then after, we'll be investing considerable amount of time in understanding the current expected credit loss method or model. So what all models are being, you can say, approved by the standard or being considered in the standards, which you can use for calculation of the expected credit loss. Right. So we'll be understanding different kind of models like discounted cash flow model, non-discounted cash flow model, probability model, and couple of other models. So those models will be understanding, and all those models are being acceptable for the relevant circumstances and conditions and the information available to the management and to the auditor when they are performing the audit. Right. So we'll be understanding that in detail. Then after, we'll be investing some time in understanding available for sale debt security impairment model. So how to do the impairment of available for sale debt security. That's also like one of the longer topic covered in ASC 326. And as of now, like in your book, we have very small topic, but you can expect good amount of questions on available for sale debt security as well, especially like impairment side of it in your exam. And then after, we'll be investing some time in presentation and disclosure. And after that, if you have any questions, so we'll be discussing those. Parallelly, for each topic as standard, we do like some practice question also. So I've also embodied certain practice questions for us to do the practice parallelly for the respective topic as and when we'll be covering those. Right. So this is all we are planning to cover. We'll target to finish this standard today, but if like it take longer time, then probably we invest 1 more hour in the next class. But let's take a target to finish it off today. So without wasting much time, let's jump into the definition of expected credit loss first. So first, let's understand what is current expected credit losses. So current expected credit loss is a credit loss accounting standard, or you can say model, that was issued by the FASB in June 2016. The CCEL, in short form we call CECL, current expected credit loss. CECL replaced the current allowance for loan and lease loss standard, which was ASC 310 earlier. Now the new standard, which is 326, has taken in effect, which is much broader standard, and more importantly, CECL standard focus on the estimation of expected loss over the life of loan, while the current standard rely on incurred loss. So what was the difference or deficiency in the current standard, and why the need of new standard have came up? Because the current standard, when we are estimating the loss, we will be estimating the loss based on the you can say management bust estimate, but the actualization of booking of the expense based on the earlier standard was on incurred basis. That means as in when you actually incurred the loss, you are booking that loss. Whereas looking at change in economic environment, change in accounting environment, it is being more predominantly used that we should consider any estimated loss and to be booked those estimated loss upfront. If you remember in the ASC 606 also, we have considered this principle on the onerous contract. If there is any onerous contract, we should book the losses upfront. Same way here also, if in any contract you are expecting to be incurred any loss, then that loss need to be booked upfront rather than waiting for actually incurred of that loss. So that was a significant reason why this new accounting standard codification has took place instead of the earlier accounting standard codification, which was based on the actual losses, or you can say booking of the losses as and when they are incurred. Why CECL was required? The CECL model has been introduced to replace the incurred loss model, like which we have discussed. So which was widely criticized for not recognizing the credit loss at the early stage. So earlier method, which was booking the loss as and when they are incurred, was highly criticized by the many accounting standard professionals, right? And they were saying, for normally the theme of the accounting standard is to follow the conservative approach. But why we are not following the conservative approach in this ASC? So hence the ASC 326 discussion have initiated to bring that more on estimation basis than on incurred basis. Because incurred basis, you will see, you will book the loss as and when it is actually incurred. Whereas as per the conservative principle, which is the theme of any accounting standard, or which is theme of the financial statement framework, we should be estimating the loss in advance and booking that on a timely basis to avoid any uncertainty in the financial statement at the current stage as well as in the future stage. Hence, this new accounting standard codification have took place, right? Any doubt so far? What is CECL, current expected credit loss method, and why this new accounting standard codification have came?
No, sir.
Yes, sir.
Yes.
One doubt. I mean, just want to link with the ASC 606. So the example that we discussed at there, it was like second year, the estimated cost and the actual cost is more than the contract value. So at that time we are recording that loss. So is that loss we are discussing here in this ASC?
No, very good point. So when, like, if you remember, when we started accounting standard codification, one thumb rule I have shared with you: when there is a specific standard, then we need to follow that specific standard. If there is not specific standard for any transaction, then we need to follow journal standard. As in the ASC 606 is for the contract, right? Revenue recognition from the contract, right? In case of those revenue contract, we need to follow ASC 606. And for all leases arrangement for the property, plant and equipment, we need to follow ASC 842. But this standard is more for financial assets, which is like your loans, which is like your receivable, which is like your debt, which is like your bond. Right? So this is more relating to the financial asset than the contractual arrangement, which is for generation of the profit, right? But theme is same what you are saying, but this is for more toward the financial instrument and financial assets.
Yes, sir. Understood. Thank you.
Yeah, theme is same, but application is on different line item. So here, if you see ASC 326, the new standard require entity to use the following three models. One is new expected credit loss model, which is ASC 326 subsection 20. In that, it consider financial assets measured at amortized cost, including receivable. So what all comes which is in scope? Trade receivable, insurance receivable, held till maturity debt security, and loan receivable, right? Second line, if you see, the net investment in lease recognized by the lessor. From the lessor standpoint of view, you have lease receivable. If you remember, in the ASC 842, we discussed the concept of lease receivable from the lessor standpoint of view, right? For that also, lease receivable also, if there is any expected credit loss that you are not expected to receive or recover the fully money, then you need to apply ASC 326 and need to book the losses. Third is off-balance sheet credit exposure of loan commitment, standby letter of credit, or financial guarantee, and any other similar instrument. For them also, you will be applying ASC 326. So what is in scope? Your financial assets. Financial assets include receivable. Receivable include trade receivable, insurance receivable, other receivable, held till maturity debt, loan receivable, or in case of lease, from the lesser side, lease receivable. And there are some off-balance sheet item also, which is loan commitment, letter of credit, financial credit, financial guarantee, or other similar instrument that is being in scope. In addition to that, ASC 32630 also covered available for sale debt security, impairment loss model. So hence AFS, available for sale debt security, is also being in scope. Last one is existing model of certain beneficiary interest, which is ASC 32540, classified as held till maturity or available for sale debt security that are not of high credit quality, is also being covered in ASC 326. So if high level, if you see, understand what all being in scope in ASC 326 is all your financial assets, whether it's your trade receivable, insurance receivable, other receivable, held till maturity, loan receivable, lease receivable, commitment, sent by letter of credit, financial credit, financial guarantee, other similar instrument, and available for debt security and any high credit quality debt security or held till maturity security is being covered in ASC 326. So these all comes under the preview of 326. So the guidance also include new model for initial recognition of purchased financial assets with credit deterioration. So under this approach, the entity will record as the initial amortized cost sum of purchase price plus estimated credit loss as on the date of acquisition. And thereafter, the entity will account for purchase credit deterioration, which is assets using model listed above. So high level, just keep in mind what is in scope, and then initial recognition, subsequent recognition we'll be discussing more in detail. But as of now, from this slide, just keep in mind what is in scope of ASC 326. Any doubt here? Rahul, Ayush, Pulak,
No, sir.
Santrupti, all good?
सर ये लास्ट वाला जो था ये मेरे को थोड़ा सा
This we'll be discussing, like initial recognition and subsequent recognition we'll be discussing in detail. Don't worry. So just, high level initial recognition is your purchase price which you are paying minus if there is expected credit loss at the time of acquisition.
okay.
Very simple, right? And then purchase credit deterioration we'll be discussing in detail.
सर ये ऑफ बैलेंस शीट क्या होता है, मतलब फाइनेंसिंग बहुत सारा
Yes, very good point. So did you get a chance to look at the financial statements of GM or Microsoft which I have shared with you by any chance?
नो सर.
then it's not fair. One second, let me show you something. So one second. So like these kind of guarantees, these are not recorded in the financial statement, but disclosures are required. It's called off balance sheet item. Off balance sheet item are those items which you do not record, which you do not account for, but it is being important for the user of the financial statement to know.
So it's related, but warranty तो हम we do the estimate.
No, warrant. I'm not saying warranty. I'm saying off balance sheet item. Off balance sheet item. For example, you have given a guarantee for any third party. If that third party will not pay, then I will pay. Right? Unless until that third party default, you are not liable to pay. Makes sense? For example, Kamal has taken a loan and Prashant is a guarantor for that loan. So what does it mean? If Kamal failed to pay, then bank can claim from Prashant. Make sense?
Yes, sir. So
in this case, and let me finish. In this case, does Prashant need to account for if Kamal is not defaulting? Answer is no.
yes, sir.
If Kamal get default, right, and then bank come to Prashant that you need to pay, then it is your real liability. Right? In that case of scenario, when you need to book the liability, you need to make the transaction, you need to make the accounting entry. Right? But till that extent, for example, if Prashant is running his company, does the Prashant investors are not interested in knowing this arrangement which Prashant has made with Kamal? Answer is yes.
Yes, sir.
So that's what is called off balance sheet item, which are being relevant and important for the user of the financial statement.
So basically, I'm giving guarantee to someone, and I have to assess like whether they are going to pay or not.
No. If that guarantee is material, then you mandatorily have to disclose. For example, instead of Prashant, you are, let's say, ABC company and I'm XYZ company. right? So ABC company has given a guarantee on behalf of XYZ company to the bank. If XYZ company will not pay, then ABC will pay. So now you wants to invest in ABC company. So as an investor, will you be interested in knowing this transaction or not?
Yes,
Hmm?
yes.
You'll be definitely interested in knowing this transaction, right? Because there may be possibility in future XYZ fail to pay the bank, and then bank come to your door and ask for money, and
Yeah,
then then it will be trouble for you. So as an investor, as a stakeholder of that company, it's being a relevant information for you.
yeah. And when do we record or when do we like take this hit on our balance sheet? Like,
When actually, like if I default and bank comes to you, then it will be your actual liability. To the If I'm not making any default, till the time you just need to disclose it
okay,
for
okay.
the user of the financial statement.
So there is no, I do not need to estimate that whether this
No,
person is going to
no,
default
no,
or not.
no, 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 no. Until I actually make the default.
Okay. And another point was a trade receivable. It is different
Mhm.
from account receivable, right?
No, account receivable, trade receivable is same thing.
Okay.
It's just interchangeable word.
Okay. Thank you.
Mhm. Everyone comfortable with off balance sheet item, loans commitment, letter of credit, financial guarantee?
Yes, sir.
Huh?
Yes, sir.
Right? Rahul, Santrupti, Ulak, Aditi. Good?
Yes, sir.
Yes, sir.
Okay. So now what is out of scope? So equity instrument, which is already being covered in ASC 321. So that is out of scope. Loan made to participant by defined contribution employee benefit plan. So like company do have employee benefit plans? Yes? No? Have you heard about them? Employee
Yes.
benefit plan. So in that employee benefit plan, generally it's being third party who manage that employee benefit plan. It may be sometime trust or it may be sometime insurance company, right? So that trust or insurance company can give certain amount of loans to the employee against the amount they have deposited, right? For them, there is a specific standard ASC 962. So hence, that is not come under the scope of ASC 326. Third is policy loan receivable of an insurance entity. So if you see, like if you have like life insurance or if you have some other insurance, so against that insurance, also you can take certain amount of loan, but that will be covered in ASC 944, how to deal with such situation. And that also is not come under the ASC 326 purview. Right. Next is pledge receivable for a not-for-profit entity. For not-for-profit entity, all the accounting treatment has been defined in ASC 958. Hence, that also is not covered in ASC 326. And any loan and receivable between entities under common control, like related party, it comes under ASC 850. So, like we discussed earlier also, when there is a specific standard given, then general standard will not apply. As for such kind of loans and receivable and financial instrument, there are already specific standard. So hence they need to be dealt according to those respective accounting standard codification, right? So it's not comes under the ASC 326 category. Make sense? Any doubt here? So far so good. What is in scope?
Yes.
What is in scope? That's question.
Trade receivable, then insurance receivable, health, something was that, and then offshore balance sheet items.
Offshore ni off
Oh,
off the
I'm
balance
sorry.
sheet.
Oh, I'm sorry. I'm sorry.
Off the balance sheet item. Yes, yes. What else?
यही सब था फिर। से एक बीच में था, बीच वाला था पैराग्राफ कौन सा? Debt security payment bond.
Which one?
AFS.
AFS, debt securities.
What is AFS?
Available for sale.
Available for sale, debt security. What else?
बाकी तो बोल दिया सर, trade reinsurance, other receivables, net investments in leases recognized by a lessor.
No.
Okay. तीसरे वाला.
No, yeah, net investment in leases, that's fine. Yeah, lease receivable. What else? Held till maturity debt security, loans receivable.
Yes.
Right? This is very important and you'll see a lot of questions around it. So what is out of scope?
Equity instruments and policy loan receivables of an insurance entity. Pledge receivables, loans and receivables between entities under common control.
सर ये आप स्क्रीन पे लगा रखे, आपने ये पढ़ के बता रहे और हंस रहे हो.
I'm just helping you to revise, you know. I don't know how many of you are actually doing revision. But I want each one of you to pass in one go. That's my goal. Yes. So entity should continue to apply ASC 450, which is loss contingency guidance to this financial instrument. Okay, so now coming to the effective date. So that's not very much relevant nowadays. Like 15 December 2019 for public company, and which is like SEC filer. Non-SEC filer public company 15 December 2020, and all other companies which is not a public company 15 December 2020, and interim period with the annual beginning after 15 December 2021. So in this year, it's being applicable for all companies. Transition relief, so it's not applicable for you, but yeah, transition method. So you should know, like generally, if there is any new accounting standard codification came, so there are two type of transition method. One is complete, or you can say full retrospective method. The another is modified transition method. Generally, whether it's like ASC 606, 842, 326, whenever any new accounting standard codification came, it come up with the both type of transition method, and both are acceptable as a transition method. What is modified transition method? When you are applying to all the open items in the on the balance sheet date and taking the impact on the opening financial statement. So apply the guidance to all outstanding financial instrument at the beginning of the year of adoption. For example, if you are adopting this ASC 326 in financial year 2022, so on 1st January 2022, whatever the transactions you have for trade receivable, insurance receivable, other receivable, held till maturity security, loan receivable, lease receivable, available for debt security, to all those open items at the beginning of the year, you will be applying this standard and understanding what is the impact of this new standard. So whatever is the impact, you will be identifying that you need to recognize cumulative effect adjustment to the opening balance of retained earning. Right? Make sense? Yes, no?
Yes, sir.
So what you need to look at it on 1st January 2022, whatever the balances you have for account receivable, for loan receivable, for lease receivable, available for debt security, and all such in scope items. To those items, you will be applying ASC 326 as if it is being applied to the balance sheet date. So whatever is the difference, whatever is the impact, that impact you need to consider net of taxes in the opening retained balances, retained earning balances. So that is called a modified transition. What is full retrospective? Full retrospective means the standard is being applicable since the beginning of the company. Right? Then you need to look at all the transactions you have made since your inception, which is coming under this in scope category. So all the receivable since beginning, all the loan receivable since beginning, all the available for debt security, all the lease receivable, everything on each and every item, you need to consider that the standard was always being applicable. And then you need to calculate the impact. And once you calculate the impact, that impact you will be adjusting again in the opening balance of retained earning for the first reporting period of the presentation. How many years we present in the balance sheet?
3 years.
3 years.
Are you sure?
Yes, sir.
2 years for balance sheet and 3 years for income statement, I
Sure.
guess.
Absolutely right.
Okay.
2 years for. Come on, guys. I think I've shared all these things with you.
years में उसमें हो गई कि P&L में ही था सिर्फ वो, मुझे लगा
हाँ.
बैलेंस भी in US GAAP ये करते हैं.
So this is like your notes accounts. But have you seen, like, by any chance, have you gone through these financial statement? If you read this financial statement, almost 50% you had already done for FAR, I'm telling you. If you have really seen this. So cash flow statement, you see like 2 years. So this is like a balance sheet, 2-year items, right? Whereas income statement, you will see 3 years.
बैलेंस शीट दिखाते हैं और ये P&L 3 years, मतलब
Yes.
ऐसा क्यों है, मतलब क्योंकि P&L
This US GAAP framework.
हाँ जी,
This is US GAAP framework, basically.
मेरा मतलब ऐसे क्वेश्चन इसलिए था क्योंकि जनरली अगर इंडियन स्टैंडर्ड से IFRS में भी देखें तो हर जगह 2 साल का ही कंपैरिजन होता है फाइनेंशियल्स में.
But US GAAP require 3-year income statement item.
Okay.
That's a difference in presentation and disclosure. Yes.
Okay.
Any doubt on transition method? Now jump into the main topic, which is objective of accounting standard 26 ASC 326. So recognize an allowance for credit loss that result in the financial statement reflecting the net amount of expected to be collected. So what does credit loss mean? Like, in general, what do you mean by credit loss? As a layman, what do you understand by credit loss?
Sir, I understand ki there is some receivable and it is doubtful. I mean, expected है कि इससे losses हो सकते हैं इस receivable में या कुछ ऐसा कुछ credit पे हमने किसी को कुछ दे है तो वो receive में loss हो सकता है.
How about others? Rahul, Santruti, Prashant. Aditi, Ulak.
It is like, sir, for me, it is a conservative principle where we are like trying to record losses or expenses as soon as we know it, we know about it.
That is okay, but what is credit loss? What do you mean by credit loss?
Credit loss is something we are expecting some losses because we have
Losses on what, basically?
on financials instruments.
What kind of financial instrument?
Like you held for maturity, like those are the debt instruments. Then off balance sheet financing.
No, not on off balance sheet.
Financial assets.
What is financial asset?
Those are like investment in equity, then in debt.
No, investment in equity covered in different standard which we have discussed.
Yes,
ASC
yes,
321.
yeah. But here I think it's a debt or maybe I have given given some
What do you mean
credit.
by credit? What do you mean by credit?
That is a kind of a loan.
Yes. So any amount or any goods and services you have already provided to any third party and you have given a credit to them to pay you back, right? It can be the loan, it can be the asset on lease, it can be sale of goods, right? Or it can be any financial support. So you are expecting there may be a possibility that the amount which you have given to them on a credit, there might be some challenges in the recovery of the complete amount, including the interest. Even though you are a bank, let's assume, and you have given a loan on interest, and you are expecting generally 0.5% or 1%, you generally expect the loan will not recover. That will go NPA. Have you heard about this term, NPA? Non-performing assets, right? In the banking industry, very much famous, right? Same is here also. So any financial support, assistance, or any goods or services you have provided to third party against which you are expecting to receive the money later on, including interest. So on those money which you are expected to be received in future is called the money you have given on credit, or money is on credit which you are expected to receive. And any loss on that will comes under ASC 326 category. Make sense?
Yes, sir.
So for this expected credit loss method, there are 4 core concepts which we'll be discussing one by one in detail. First one is based on assets amortization cost. So there are certain assets which use amortization method to expense of. Hence, the related credit loss also need to be considered on an amortization basis. So we'll be discussing in detail about that first core concept. Second is reflect the losses over an asset's contractual life. So if you have incurred certain financial losses or expected credit losses, that losses need to be recognized over the contractual life of the assets, or each period of the financial statement closing, you need to reassess certain losses. So that we'll be discussing in detail. Third is consider available relevant information. So whenever you are planning or whenever you are expecting any credit loss, so at that point of time, what are the best information available to you as a management? It's being your responsibility to consider all those relevant information. You cannot ignore any relevant information when you are doing estimation of expected credit loss, because expected credit loss is an estimation. This is not actual loss. This is estimated loss. So when you are estimating anything, it is your primary responsibility to consider all the relevant information which is being available at the time of making such estimation. Last is reflect the risk of loss in the financial statement. So this we'll be discussing one by one. So let's jump into the first one. Based on asset amortization cost. Expected loss refer to the portion of financial assets amortized cost basis an entity does not expect to collect. So if you are expecting not to collect any money, then you need to look at the credit loss, and accordingly you need to do the calculation of allowance, which is being dependent on the entity approach of measuring that expected credit loss. So there are 2 methods which is being given in the accounting standard codification. First is using discounted cash flow approach, and second is not using discounted cash flow approach. So if you are using discounted cash flow approach, the allowance should reflect the difference between the amortized cost basis and the expected cash flow discounted at the present value at the effective interest rate. So what is the loss? Is the difference between amortized cost, that is your book value, and the present value, which is based on the discounted rate of interest. Whatever is the difference is your estimated loss. If you are not using discounted cash flow approach, then allowance should reflect the expected credit loss of the amortized cost basis the financial assets. So normally, if you see how you make provision for doubtful debt, any idea how we make provision for doubtful debt? Yes, no? How do we calculate provision for doubtful debt? Are you guys here?
सर ये प्रोविजन फॉर डाउटफुल डेट्स पास्ट ईयर ट्रेंड्स के बेसिस पे कि कितना कंपनी रियलाइज कर पाई है ओवर द पीरियड ऑफ 5 years 10 years एंड उसी बेसिस पे आगे फोरकास्ट करते हैं कि हम कितना रियलाइज करेंगे तो उतना परसेंट ऑफ डेटर्स दे मेक एज प्रोविजन.
Yeah, anyone else would like to add? Provision for doubtful debt, sometime we create based on the past experience, which I used to, right? Sometime we have like company policy and we consider based on the aging, like 0 to 30 day, 30 to 60 day, 60 to 90 days, more than 90 days old. And accordingly, respective percentage is being applicable and will calculate, right? So that is called non-discounted cash flow method to calculate the expected credit loss. Make sense?
Yes,
Yes.
sir.
Second core concept is reflect the risk of loss. So the risk of loss, there might be couple of categories possible. So we need to identify the similar risk category or similar risk characteristics, and we can club them together. And if there are certain risks which are not similar in nature, then we need to identify them separately and consider them separately. So to the extent if the risk is of similar nature, for example, you have account receivable. For example, you are, let's assume you are in the sale of what you would love to sell, electronics item. Let's assume you are selling watches. Right? Let's take an example. You are selling watches. You are selling watches to the distributor as well as to the corporate for gifting. So for corporate for gifting, when you sell, you get a bulk order and you get the advance 50% and 50% you, let's assume, receive in 30 days. But when you sell it to the dealer, so it go on a credit. And to the dealer, you have like national dealer as well as international dealer. So international dealer, let's assume they need to give you letter of credit. So once they give you letter of credit, then risk is comparatively low and the collection is timely from the international customer or international dealer. But to the local dealer, you have, let's assume, 5 dealer. One is in north, east, west, south, and central nation, right? So in that you have seen like North India person are most of the time make the delays in their payment. So in that case of scenario, if you see the overall, you have different buckets. So one, in terms of sales, you have distribution channel and you have corporate sales, right? In the corporate sale, you have less risk because you receive 50% advance and rest of the 50% you receive within 30 days and you do not have any history of any default. Now coming to the distribution channel. In the distribution channel, you have two buckets, national and international. So in the international, before making sale, you get the letter of credit. So your money is being secured against the letter of credit. Right? Now coming to the third part, which is distribution at the local level. In the local level, you have east, west, north, south, and central region distributor. Right? To those distributor, you can consider into a separate bucket and see how much is their default pattern. So what does it mean? Reflect the risk of loss. First is expected credit loss should include a measure of expected risk of the credit loss, even if that risk is remote. So in all this category, first you need to do is the segregation and the aggregation of the similar risk. First, you need to segregate what all category of risk are there, and then you need to aggregate what all risk are of similar nature, and then you need to evaluate those kind of risk in a one go. Whereas the separate risk need to evaluate separately. So level of aggregation is require a collective or a pool-based approach when similar characteristics exist. Allow the individual approach when there is no shared risk character. An entity is generally not permitted to estimate a zero loss simply because current value of the collateral exceed the financial assets amortized cost. So we'll come to that. So if you remember in ASC 606, we have studied the combination of performance obligation, right? Do you remember the concept of identification of performance obligation and combination of performance obligation? Yes or no? Are you guys with me? Break में तो नहीं
Yes, sir.
चले गए.
Nice, sir.
So do you remember in step 2 of ASC 606, which is identification of performance obligation, what we will be considering? The nature of different kind of performance obligation, right? And then combination of performance obligation. So what are performance obligation we were combining together, which are of similar nature? Here also, we need to categorize the risk and then see what all risks are of similar nature and then bucket them as a single risk category and evaluate them as a single risk category. And what all items not come under this bucket, then those items need to be evaluated independently. Make sense?
Yes, sir.
Rahul, Ulak, Aditi,
Yes, sir.
Santrushti, right?
Yes.
So this is what it means. But if you look at this last line, an entity is generally not permitted to estimate a zero loss simply because the current value of the collateral exceed the financial assets amortized cost. For example, you are a bank, right? And you have given a loan to someone for the purchase of household, and that person has given you that household document to you. Generally, like how many of you have taken home loan or car loan or any other loan? Have you guys taken any such loan?
Yes, sir.
Right?
Okay.
So what happened in that loan? So bank will take all the original document into their possession, right? And look at all your credit score, your your incomes records, your tax returns, and see all your credit worthiness, and accordingly they decide the amount and give it to you as a loan. Let's assume the property worth 100,000 you have purchased and you have taken a loan of $80,000 on that from bank, and you have given a security of $100,000 property to the bank. But does it mean that bank should not recognize any credit loss if you are a defaulter? The answer is no. That's what the last point is. Make sense? Just read
Yes.
this last point again for me.
An entity is generally not permitted to estimate a zero loss simply because the current value of the collateral exceeds the financial assets amortized cost basis.
Right? Makes sense? What example we have discussed? If you have taken a piece of land of $100,000 and for which you have taken 80,000 loan, bank still need to evaluate the credit loss if you are in default or if you're defaulting. It does not simply mean if bank has collateral security more than the face value of the loan, it should not recognize expected credit loss.
सर आई थिंक ये इसलिए भी है क्योंकि अगर आप उस केस में देखो जैसे विजय माल्या का केस था, he had taken loans from SBI.
Yeah, PNB.
They already had that collateral with them. So उसकी properties and all थी, but it took them years to sell it off. I don't know. वो sell off ही नहीं कर पा रहे थे, तो वो at least उनको पैसा realize हो ही नहीं पाया आखिरी तक.
Yes, yes.
I think
That's what
yes.
Absolutely. That's what the practical expedient is.
Yes, sir.
Right? Everyone agree? Huh? Santrupti, Prashant,
Yes.
Rahul?
Yes, sir.
Okay. So now next is consider available relevant information. What is available relevant information? Expected credit loss should reflect the losses that are expected over the remaining contractual life of asset For example, if you have given any loan to someone for a period of 5 years and 1 year that person has repaid. So now you have remaining balance for the period of 4 years. So you need to estimate for the remaining 4 years rather than the complete 5 years. So here life of an asset. What do you need to consider? The contractual maturity date, prepayment option and experiences, reasonable expectation of trouble debt restructuring, and then extension option outside the lender's control. What all things you should not keep in mind is expected extension not explicitly provided for in the contract. Second is extension option in the lender's control. So the extension option should be clearly mentioned in the agreement, whether you're going to extend it or not. If it's not mentioned, then you should not consider it. And second thing, if extension option is only available in the hand of lender, then also you can ignore, because the person who is taking money do not have authority to do the extension. So in that case of scenario, you can ignore that. Fourth objective or core concept is reflect losses over an asset's contractual life. So losses you need to reflect over the contractual life of the asset. So contractual life of the asset, for example, you have given a loan. Let's assume you are a bank, right? You are a bank and you have given a loan to any customer for a period of, let's assume 20 years for a home loan, $80,000 you have given to them. Right. So in that case of scenario, you need to estimate this expected credit loss at each balance sheet date. It's not like in the one time you have estimated and then you are good. No, every time at each balance sheet date, you need to re-estimate. So that's being your responsibility under ASC 326. What all things you need to consider when you do the re-estimation? First is reasonable and supportable forecast. Second is current condition. Third is asset specific condition. And fourth is historical loss information of that individual. So these four things you need to keep in mind when you are estimating. But estimation you need to do at each balance sheet date. That's your responsibility. So the estimate of expected credit loss should reflect available information that is relevant to assessing the collectibility of cash flow. Any doubt here?
सर ये जो बैंक लोन देता है, ठीक है, so suppose 10 years के लिए they have given the loan, but after 10 years they restructure it as well, तो उस केस में हमारा लॉस तो हमने 10 साल तक पूरा कर लिया होगा recognize.
No. You are going in a different direction. For example, ABC Bank, and Akash is a customer, right? Ayush is a customer. Ayush took $80,000 loan for 20 years to purchase a new house of $100,000. So here every year or every month, Ayush is submitting EMI, which include principal and interest both, right? So at year end, if you are doing all this timely payment, then at year end, there is no expected credit loss, right? But for example, you have made 8 payments of EMI on time, but on 4, you are delayed.
Okay.
Right? In that case of scenario, for remaining 19 years, bank need to estimate how much probable delay you can make and how much would be the expected credit loss. So your credit score will go down in the bank.
Right? अगर मतलब जैसे ये होता है कि आपने जितना अमाउंट था हमने एस्टिमेट कर लिया कि अच्छा इतनी रिमेनिंग लाइफ के ऊपर हमने उसको ग्रेजुअली रिफ्लेक्ट करना है जो हमारा क्रेडिट लॉस है, ठीक है. अब प्रिंसिपल अमाउंट होता है, हमने उसको ही आपने बोला कि अब 10 साल की जगह उसको हमने 15 साल में आप दे सकते हो. तो उस केस में फिर वो जो रिमेनिंग दोबारा से ये साइकिल शुरू हो जाएगी उसकी क्रेडिट.
यस, एवरी बैलेंस शीट डेट दे नीड टू रीअसेस.
हाँ, क्योंकि वो रीस्ट्रक्चर हो गया तो वो पूरा फ्रेश ट्रीट होगा कि अब मैं, और जो existing loss हमारी books में recorded होगा, what we will do about that? क्योंकि वो एक बार पूरी amount वही amount दोबारा restructure करा.
Yes, look at the practical experience. For example, you have taken a loan for 10 years and you have made certain defaults in year 1, and at the end of the year you go to the bank to do the restructuring for 15 years instead of 10 years because EMI is high and you are not in a position to pay.
Yes. Oh.
Right. So in year 1 they have already booked certain losses.
Okay.
So now they will do the profiling of your case at a higher credit risk, and they will charge you higher interest rate because their risk is high.
Okay.
So now they will, earlier you might be in this bucket, but now they will put you in this yellow bucket.
Okay.
And then your profiling would be different, your interest rate will be different, so that it will cover their risk.
Okay. Got it.
Cool. Let's do some practice question. Are regulatory assets of a power and utility entity is in scope of current expected credit loss model? The answer is no. Right? So this is being covered in the 900 series category, which is industry specific. So hence it is not covered in ASC 326. Second question is, are cash equivalent in the scope of CECL model? So answer is yes. Cash and cash equivalents are covered in ASC 326. Third is, are loan held for sale in scope of CECL? So this also we have discussed. Yes. So loans held for sale, held till maturity, and held available for sale debt security are being covered in ASC 326. Next is, are loan and receivable to equity method investing in scope? The answer is no. That comes under ASC 321. Next is, are tax receivable from taxing authority is in scope of CECL model? The answer is no. That comes under the tax engine. Last is, are employee forgivable loan in scope of CECL? The answer is yes, if it meets the definition of financial assets. If it is coming under the defined benefit plan, then it is not. Make sense?
Yes, sir.
Any doubt on any of these questions? So far, so good?
Yes, sir.
Shall we take break before jumping into the new topic?
Sir. Break ले लेते हैं sir.
Break ले लें, or shall we continue because next topic is bigger. Yeah, so let's take a
Sir,
break
वो
over here.
bigger.
Sorry, say that again.
वही बोल रहा था sir. Break ले लेते हैं.
Okay, it's 11:50. Let's come back at 12:20.
Okay.
Okay. Let's come back at 12:20.